title and company?
Yes. Oh, I should do it.
Oh, please.
Yeah. I'm Jim Grant. I'm the editor of Grant's Interest Rate Observer, and what I do for a living is write. I want to interview famous people, but who are famous perhaps for reasons that the public is not fully aware of. I hope to elicit from them new thoughts, frank admissions of things that they had not previously admitted to, and I want to get them to laugh once or twice. Well, up next on Real Vision is a conversation with Dan Rasmussen, who is quite an accomplished character. Dan went to Harvard, as some people do, unusually for even a Harvard guy. He wrote a thesis which turned into a book called American Uprising, and it appeared when he was at the tender age of 23. And Dan then went on to found Verdad Advisors. And he's an investor, he is a thinker, and a most accomplished essayist. And his essays deal with topics that pertain directly to the fine art of buying low and selling high. So please join me in a conversation with Dan Rasmussen. Well, I am seated directly across from Dan Rasmussen, a prodigy, an actual Forbes 30 under 30 entrant. He has turned 30, so that's kind of historical now.
It's old news.
And let's see, summa cum laude at Harvard, Phi Beta Kappa, of course. Stanford MBA, and if time permits, we're going to get into the rest of this program. I'm not finished with his resume yet. And the author of a published work of history called American Uprising, and that was published in his 23rd year, which actually provoked an act of reportorial condescension masked as a review in the Washington Post. The guy said, the critic said, paraphrasing Samuel Johnston, they said, it's not remarkable that a man should produce a work that has some flaws. It was remarkable that he should produce a work at all at the age of 23. So I want you to know, Dan, that you're not going to be patronized on this program.
Well, thank you, Jim.
So substantively, Dan Rasmussen is here, not because of his CV, as formidable as that is, but because he is a man of parts concerning the fine art of buying low and selling high. And I have had the privilege of encountering his prose because it was put in front of my eye by a mutual friend of ours. But I've read essays, Dan, of yours on private equity, of which you are not a fan, of modern portfolio theory, of which you are not a fan, of modern financial theory, and of the thoughts as they pertain to investing of Michael Porter, of which you are not a fan. Are you a professional iconoclast?
I guess I need to come up with something that I am a fan of after you've given me that list of things I'm not a fan of.
You're a happily married man, aren't you?
Yes, I am. But she is a PhD in clinical psychology, so she works with crazy people for a living. So
it's like a busman's holiday when she gets home.
Yeah, exactly. So I don't know. Her vouching for me might be good, or might
But you do seem to have, if I may be permitted to speculate, it seems hardly a thing to do on really 10 minutes personal acquaintanceship. You do seem to be a man predisposed to taking the contrary position. Is that not correct?
I think that's always been part of my DNA since I was a child.
Okay, so your investing life, which is now 4 years old, you
Yes.
had a career after Stanford
Yes.
at Bain. You were a
Yep.
consultant.
I was in private equity at Bain Capital. That was prior to business school,
Yeah.
and then
Prior.
Yep, and then started my fund after business
And
school.
then Bridgewater.
During college as an intern,
right?
yes.
And then Verdad
Yes.
Advisors. That's with an E, A-D-V-I.
Yes, that's correct.
E-R-S.
Yep. Yes.
O-R is kind of pretentious, right?
Yes. Yeah.
Right. So tell us about, I want you to tell us first about Verdad, which is truth in Spanish, you have
Yes.
informed me. And then we're going to double back, and you're going to tell us about some of the ideas that have informed you and perhaps have propelled you. So
Yes.
tell us about Verdad, which you founded 4 years ago.
Yeah, the premise of Verdad was really very simple, which is that if you looked from 1980 to 2010, private equity as an asset class outperformed the public equity market by 6% net of fees per year. And they were charging 2 and 20.
With 6 percentage points.
Per year.
Yeah.
According to the industry data, so maybe it's a little optimistic. But in any case, I think it's hard to argue with the early track records in the 80s and 90s of Bain Capital, KKR, Blackstone. I mean, they were phenomenal. And if you look at what did they do to generate those returns? Not what they call themselves, that they're private equity or that it's operational improvement or the marketing, but what did they actually do? Well, they did transactions that met three key quantitative criteria. They were small, so the average market cap of a private equity transaction is about $200 million. So these are micro cap transactions. Second is that they're levered. So this is the leverage buyout industry. And from the very beginning, every deal was levered 65% or more. And 65 is the long-term average. In the 80s, it might have been as high as 80,
yes.
80, 90, sometimes even more. And then third, and this is really interesting, private equity for many, many years bought at a substantial discount to the public markets. When private markets were inefficient, in the early 80s, I saw a letter from Mitt Romney saying that this was in 93, and he said, I'm getting worried about valuations because we're no longer able to buy in the 4 to 6 times EBIT range in which we used to over the past decade. 4 to 6 times EBIT. I mean, they were buying these things so cheap.
That's earnings before interest and taxes. I noticed you didn't say EBITDA.
Yep.
Which is, did you intentionally?
That was I'm just because I was quoting from him, but I think broadly in the 80s, 90s, and early thousands, private equity was buying at less than 7 times EBITDA on average.
Now, what would that translate to in price earnings terms?
It's hard for me to do the conversion because every deal is so levered that you have to. That's why you look at EBITDA. But the public equity market over that period, the S&P 500 was maybe trading at 10 or 11 times EBITDA for long periods of time.
The market was cheap by our lights. Interest rates were high by our lights.
Yes.
And these companies were marginalized.
Right, and they were buying them cheap in private markets. They were using the cash flows to pay down debt, and then they were selling them at higher multiples. And so all of those things were wonderful and smart. But what happened is that in the mid-thousands, private equity became an asset class.
Yes.
And it's something that you had to have an allocation to. And money started pouring in, and deal multiples went up and up and up until they were equal to and now almost higher than public equity markets. And what's problematic about that is not just higher valuations mean you can't get multiple expansion when you sell, and buying higher is obviously worse than buying lower. But the amount of leverage to get to a 65% levered transaction went up and up and up. When they were buying at 5 or 6 times, they were putting 3 turns of debt on, which is very reasonable. You can pay that off in 5 years. It's a great transaction. But you put 6, 7 turns of debt on the business, it's really hard to pay that off. The interest payments are extremely burdensome. Any change in your financial condition is going to lead to bankruptcy. And so what I said is, well, I want to go back to the 80s and 90s, so back to the future, and buy companies that are small, cheap, and levered, just like private equity deals in the 80s and 90s. But I found that you can't do that in private markets today because everybody is so obsessed with private equity and private markets. They flooded it with capital. Everything goes to auction. It's impossible. But if you look in the public equity markets globally, there are hundreds of companies that look like that they're small, cheap, and levered. And so I said, well, I'm going to build an investment firm to focus on those companies that have the exact same quantitative criteria as private equity in the 80s and 90s, but that happen to be public.
Yeah. So this goes back to William E. Simon in the Gibson Greetings transaction of 1970 something or other. I think they were the pioneers in this, but it was an extraordinary opportunity because it was an obscure one, right? It was outside the pale of good taste and sound practice. Leverage itself was thought to be somewhat problematical. Leverage became domesticated, the ditto private equity business, and then it became, as you say, an asset class. My friend Paul Isaac says of the hedge fund world, he says it's not an asset class. Hedge funds are not an asset class. It's a compensation scheme.
Yes.
And in a way, can you say the same about private equity? Isn't that too a kind of a compensation scheme for the general partners?
I think it's a way of holding. It's a brilliant way of holding levered microcaps. So that came upon this remarkable statistic that, I think microcaps of the past 30 years, 30% of years have been down years for microcaps.
And define a microcap for our viewers.
Sub 500 million a market cap.
Gee, it sounds like a lot of money when you say it fast.
Right, but in the public equity market, they're small. And even the S&P 500, I think it's 1 out of every 4 years is a down year. If you look in private equity over 30 years, it's 1 in 10 years.
That speaks to the brilliance of the private equity people, or does it speak to something else?
It's a leading question, Jamie. I think it speaks to that private equity is holding levered microcaps in a non-mark-to-market vehicle that's private, and so you can make up the marks every quarter rather than having to mark them to the public equity markets, is a brilliant strategy for holding the assets. And then you lock the capital up for a decade, charge 2 and 20, make up the valuations. I mean, I couldn't imagine a better business model.
Let's go back to making up the valuations. Could you elaborate on that one?
Sure. So, in public equities, your value of your company is the share price at the end of the day times the number of shares outstanding. And unfortunately, or fortunately, depending on your perspective, those numbers are very volatile. Public markets could go up 2% or up, down 2% in a given day. In a month, they could be up 6, down 10. It's just the volatility of public equity markets is crazy. It's a characteristic of the market. And I think since the 30s, people have had big dreams of saying, well, why are, prices of companies shouldn't be so volatile. This is a bad thing.
Right, the business doesn't change every day. Why should the price? Yeah,
exactly.
Right.
And private equities in some sense solve that question because they say, well, they buy a company, and then what's it worth a quarter later? They say, well, the business hasn't changed that much over the last 3 months. It's worth basically the same as it was worth before. So the old policy was to mark it at 1 times your money until essentially you sold it or had some sort of dramatic change in the business, and then you'd change the mark. But the accounting rules changed, and now they have to come up with some logic behind the valuation. But the logic is still appraisal, say, well, other similar companies are like this and exclude that outlier, and I think it's roughly here. But the end result of that is that if you look at the time series of private equity returns, it's less volatile, not only less volatile than the S&P 500, it's less volatile than high yield bonds. In terms of percentage of down years, it's actually less volatile than treasury bonds. Because it turns out that when experts do the appraisal accounting, they don't think the market valuation has changed very much each quarter.
Experts in the pay of?
In the pay of themselves, or the accountants who are being paid by the private equity firms.
The more you talk about this, Dan, the more appealing it sounds, the line of work.
Maybe we should start a fund together.
Openings? Okay, but
it'll be a permanent long-term capital,
right,
so maybe 20-year lockup.
So you had the opportunity, before you wasted those 2 years at Stanford,
yes,
of staying in Bain,
yes,
right, of climbing the ladder. God, you threw it away.
I think that my point of view then as now was that doing private equity transactions at 11 or 12 times EBITDA and taking 6 or 7 turns of net debt times to EBITDA out to do those transactions was not a strategy that was going to provide investors attractive returns.
We're not talking about investors, we're talking about Bain.
Well, I think the partners at most private equity firms are doing very well.
Yeah.
But I've always been somewhat of an idealist, and I think what makes me interested and intellectually engaged is doing something that I believe to be right and true.
That brings us to Verdad, and it
Yes.
brings us to how you look for stocks and how when what you want to avoid in stocks. But so you're managing $80 million after 4 years. So tell us a little bit, if you would please, about your portfolio, and then after you do that, I want to go back and talk to you about some of the things you've written about and how those ideas might be informing your everyday work in investing.
Yeah, so I think the premise started that we wanted to buy small, cheap, highly levered companies to do what private equity did in the 80s and 90s, and that was the genesis. That's the engine of everything we do. But what I found, and this is interesting, and touches on some of the work, I think I said, well, okay, well, how do I then choose? If there are 500 small, cheap, levered public companies, how do I choose? And I think, let's say there are a few different methods. I think one would be to say, well, why don't you just do DCF model, discounted cash flow models for each of them and choose the one with the best expected returns. But as I looked into that, I realized that the growth forecasts and also the discount rates that were plugged into these DCF models were so erroneous as to be completely unreliable, such that if you looked at any sort of empirical test, there was no way you could come to the conclusion that that made any sense. And then the next one was to say, well, why don't we buy companies that are really high quality businesses that have great competitive position. But as I looked at the evidence for that, I couldn't find any evidence that high quality businesses or competitive advantage had any sort of benefit in terms of equity returns. And so I started doing a lot of work on studying what the Chicago School of Investors, the IFAMA, French, the dimensional fund advisors, AQR, that world. What were their insights about how to predict stock returns? And I found that some of them are very valid. Value, the cheaper you buy a company, the higher the expected returns.
Hold on a second. These people are telling you if you buy low and then sell high, it's okay?
Well, it's remarkable that that's what the evidence suggests.
Yeah.
And so I've started basically saying, well, let me look for what are the long-term, and this is also, I think, part of is the influence of Bridgewater, because I think working at Bridgewater, even though I worked there for a very short period of time, Ray Dalio had a very firm philosophy, which is that you want to take something that's logical, like you should buy things cheap. You should test it empirically over long periods of time and across multiple markets. And so everything I do today, I said, well, what are the things that are logical, like buy cheap? Can I test them over long periods of time? And then can I turn those insights into principles and those principles into profitable investments, rather than making case-by-case decisions to have a set of principles. And so we found, for example, within the universe of small, cheap, levered companies, broadly you want to buy the ones that aren't going to go bankrupt.
Good call.
It was a genius insight. Well, it turns out that there's been a lot of work that's been done on what predicts bankruptcy. The credit ratings agencies do a lot of work. I mean, and you can basically take all of this research and plug it into a model, and you'll find very quickly that the stocks that are less likely to go bankrupt have higher equity returns if you're buying levered companies. And so we've essentially just tried to build over the years more and more research on what works in our universe, and apply that in investing in a systematic way.
In the late 1980s, during the what would prove to be the peak of at least one credit cycle, and certainly the culmination of a great love affair with leverage and with junk bonds, there came to be something called stub stocks. You were 2 years old. I don't mean to patronize you. In 1988 and 89, stub stocks became a thing on Wall Street. A stub stock is an equity with a very, very leveraged balance sheet.
Yep.
So the equity portion is kind of it's always a residual, but this is a truly residual. The idea was that the junk bonds would be refinanced at more advantageous rates as the business improved and as the ratings agency caught on to that improvement. And with a modicum of management expertise and of growth, bingo.
Yep.
The stub would not just be a good investment, but a fabulous one.
I mean, it's not a dissimilar.
It didn't work.
Well, now that you've given it away.
It didn't work in the cycle ending in 1990,
Yep.
because the junk bond market blew up, and these
Yep.
things it turned out were truly excessively leveraged. I've forgotten how many,
Right.
say how many turns of leverage to EBITDA, but they were, I think. Anyway, so my point, I guess, was, which I should have phrased in the form of a question, Dan, because I'm here to ask questions, not to sermonize. But credit certainly, and even ideas on Wall Street have their seasons and their cycles.
Yep.
And okay, now comes the question. We certainly, I would say, are in a season of great acceptance of lots of leverage because it costs so little money. Interest rates, of course, are historically, if not uniquely, low. And you were buying leveraged companies in this particular season. Now, does it concern you that this is not a strictly contrarian technique now?
Yeah, I mean, I think it's a great point. And I think that where you see, I think the greatest excesses of leverage are in the private markets today. Private real estate, private equity, they're taking on so much debt, and the volatility of those transactions is concealed by their private nature. In the public equity markets, I think things are quite different. I think that leverage is not looked upon favorably in public equity markets today. There is very little appetite among public equity investors to own levered companies. In fact, there's very little public equity appetite for small value stocks generally, or small stocks generally.
Could you give us an example of one or two specific names that you own and why you chose them?
Sure, yeah, and you'll find a commonality among them, but I'll give just a few examples. So I own a Japanese die casting company that's essentially part of the auto supply chain called Aresti, 5852. Aresti trades at 2.7 times EBITDA and is 54% levered. So you look at a transaction like that and say, well, either this business is going to go bankrupt, which, given that there is roughly one bankruptcy per year in Japan out of 3,000 listed public equities, seems like an infinitesimally small possibility, Or at some point, this company should either pay down debt or revalue, and it should be worth more than 2.7 times EBITDA, because that's a bizarre and insanely low valuation. Another example in the UK would be a company called First Group. They own Greyhound buses. They own school buses. First Student you'll probably see it in your neighborhood. They also own a UK rail franchise, which is unprofitable. That company trades at about 4 times EBITDA. It's about 45% levered. And so I look at that and say, companies like that have 1 or 2 or 3 turns of net debt to EBITDA, these are not big credit risks. They really aren't. What you're buying is a very cheap company that's very nicely levered, that is fully capable of paying down their debt. And so I think that broadly, is leverage a good thing? No, leverage is a double-edged sword. Too much of it is a very bad thing. And a little of it can be very helpful in the right context and the right circumstance.
Ted Forsman, one of the progenitors of Forsman Little, said that leverage is like chocolate cake. A little tastes fabulous. He was one of the people who was in private equity when it was still called leverage buyouts.
Yes.
The name was changed to reasons of at least of optical hygiene.
Well, it's funny.
After the crack up in
they keep
1990.
changing it. So it was leverage buyouts, and then it was private equity, and then it was private equity and growth capital. And now they've renamed the trade association the American Investment Council, because they're investing in America.
Who wouldn't want to own that?
I think it's worrisome, though, if you have to keep creating a neologism every 2 or 3 years to rebrand what you do.
Yeah, it's like somebody who keeps shifting his residence.
Yes.
Pay his rent. Yeah. So let's go back to what preceded the creation of Verdad, which is the ideas that you have imbibed and through your writings have helped to disseminate. And I want to ask you, there are 2 or 3 separate things that I thought were so very impressive. Let's save private equity for a little while, because I think we've given private equity the once over. Yeah, but it deserves it again, so we'll come back to it. Yeah.
Great.
Let's talk about modern financial theory, investment theory. And you wrote a fabulous piece, which I happen to have on my lap, and it's called the Bankruptcy of Modern Finance Theory. And this came out, I guess, exactly a year ago, right?
Yes.
Yeah. And I thought it was as remarkable for its writing as it was for its content, and so bravo.
Thank you, Jim.
But one of the ideas was so, to me at least, so new and so iconoclastic, and therefore but appealing, perhaps a little bit because of its very iconoclasm, was your attack on the dividend discount model. This was, as you point out, this was a body of thought propounded by John Burr Williams in 1938. And this guy was very clever with math. I'm sure he did very well in his SATs. And he created kind of an algebraic accounting.
Yes.
And if you read along with John Burr Williams, you could see into the future. And knowing the future, invest accordingly. It was a brilliant concept. Did that work very well? Did it?
Well, I think Williams' central idea is that a company is worth the net present value of its future cash flows, discounted back to the present based on a discount rate. So in order to assess the value of a company, all you need to know is its cash flows into perpetuity and how risky it is. So you can
just look that up in the Moody's manual.
And it's funny because I was speaking at my alma mater at Stanford Business School, and I said, well, you've all been taught this methodology. Does someone want to stand up and just tell me what their salary is going to be in 2023, then their net income after their expenditures, and then how much money is going to be in their bank account on December 31st? And then just assign a discount rate in terms of how risky the probabilities of you earning that salary and having that net income are. And of course, people say they have no idea. And so, well, if you have no idea for your own salary, when you are the world's leading expert in you, how in heaven's name could you have the hubris to think of what Coca-Cola's earnings are going to be in 2022 or 2023? I mean, it's the height of foolishness to think that you can see that far into the future.
And yet this conceit that the future is an open book rather than a closed book is ubiquitous in our line of work. I mean, the Federal Reserve has, I think that if you sat down with a couple of these people at the Fed and just poured them just a couple of beers to loosen them up, they might admit that actually they can't see into the future and improve that before it comes to pass. They will admit that. But they certainly come across in cold sobriety as seeming to believe it.
Yep. Well, there's a wonderful book that I think has really changed my worldview. I think it's one of the best books I've ever read. It's by Philip Tetlock, who was a student of Daniel Kahneman, who wrote Thinking Fast and Slow and won the Nobel Prize. And Tetlock was one of his star students. And Tetlock's area of interest is forecasting. How far and how well do we see into the future? So for his,
is it a short book? Is it?
It's a very short book. Yeah, you forecast what I was about to say very accurately. But Tetlock, what he does is, starting in the 80s, he had about 400 experts, so people from think tanks and academia and the State Department, and he asked them to make quantifiable forecasts 1 year in advance. So it's, is the United States going to go to this war with the Soviet Union in 1984? Yes or no? And I think he collected something like 100,000 forecasts over a 20-year period. And he scored the accuracy of the forecasts. And what he found is that experts were no better than non-experts at predicting the future, and non-experts were no better than throwing darts at a board.
Everybody knows that.
But what's interesting is that the experts had a significally higher confidence in the accuracy of their forecasts. Yeah. So it was like doubly bad.
I know, yeah. 40 years ago, I knew so much more than I know today, especially about the future. So knowing now what we ought to have known then that the future is, in fact, a closed book. We can toss out the dividend discount model in its entirety. Is that the whole book out?
I think so. I mean, I think that if your entire model is based on perfect foresight into the future, or even mildly good foresight into the future, and the future is completely unpredictable, then that entire exercise is merely an attempt to increase your confidence without increasing your accuracy. So it's doubly bad. And I think instead you have to say, given that the future is inherently unpredictable, how do I make good bets? If you're an investor, how do I make good bets? And the answer is not, imagine I can predict everything about how the world will unfold and then choose the best thing. It's to say, a priori, not knowing things, what should I buy?
Right. So we can't know the future, but we can observe in the present how people are betting on the fucture.
Exactly.
Right. And that betting takes the shape of valuations, no?
Yes, exactly.
So that leads us back to this die casting company in Japan trading at nothing.
Yes, exactly. Because I think my view is that it's an odds game, right? Or investing is a game of meta-analysis, not analysis. It's not what you think. It's what you think relative to what everyone else is thinking. And the valuations are the best metric of the consensus wisdom. And so if you buy things that are at the extreme of cheapness that everyone hates because they think, I don't know, that the die casting business is a commodity business that's in the auto supply chain. Autos are, who knows why you would hate that company so much. The margins are thin. There are dozens of reasons. But I think if you step back and say, however, it's so darn cheap, is it going to perform better than these horrendously negative expectations? I think the odds are in my favor.
You're describing the kind of the vintage 1934 security analysis Benjamin Graham. And Benjamin Graham evolved in life as I guess we are meant to do. And after security analysis came the intelligent investor, and after the intelligent investor came conversations in which he seemed to be pointing in the direction that Warren Buffett later followed, namely the notion that the price and value are not dispositive. But what you want is a really great company. And you want that at a good price, but you want growth for which you don't exactly pay. But Buffett has tossed out the cigar butt, as it's disparagingly called, the cigar butt Benjamin Graham, to embrace something along the lines of the Michael Porter view of what constitutes a really, really good investment candidate. Can you help us understand that evolution and whether it is one we ought to ourselves travel?
So there are elements of truth to it. That all things equal, if you had a very cheap company, in many cases the problem is that many cheap companies are on the path to bankruptcy. So they have a a time frame. They are truly junk. And so I think if you say, well, I want to buy the cheap things that are not going to go bankrupt, and that also fits with a sort of probabilistic worldview. If you say, well, I want to have the cheap thing, something good, something surprising has to happen for it to revalue. And I want the longest duration, the most number of chances for something surprising to happen. You want the company that's going to last the longest, which means the company that's least likely to go bankrupt. And so insofar as you define quality as that characteristic of not going bankrupt, I'm in agreement that we should buy cheap, high-quality companies. Where I disagree is this new definition of quality, which is, enters Buffett's lingo in the 80s, where he talks about wide moats and competitive position. And it's really entered the vernacular of a lot of value investors. Barriers to entry, market share.
It seems to make so much intuitive sense. You don't want to, for example, the podcast industry.
Yep.
All you need is a microphone and a guest. That's it.
Yep.
No barrier to entry.
Yep.
Anybody can do one.
Yep.
And you'd expect that for that reason that the returns to podcasting would be just as small as they actually are.
Yep.
Whereas to build a nuclear reactor, well, that takes a little. There's your moat for you.
Yep.
So what's wrong with that particular insight, as trivial as it might seem? Certainly, there's some truth in it.
Yeah, of course there's some truth to it, but once you have businesses that are generating tens or hundreds of millions of profit, the question is, how do you distinguish between the good ones and the bad ones? It's not like, of course, if the podcast empire somehow made it so it's generating hundreds of millions of profit and was in a publicly listed company, you'd say, well, there's got to be something there that's leading that guy to make money. I mean, just look at this, bottled water. I mean, why?
We're paying that sponsor. Can you hold it more?
It's a very, very lucrative sponsorship by this French water company. But why is there a moat to producing water? No, there's no barrier to entry to producing water, and yet people buy
moats
it.
Are water.
Moats are water. But I think more broadly, this idea of moats or barriers to entry, we have to look at where it comes from, and it comes ultimately from antitrust theory. So. And it comes from this school of thinking that emerges from that general den of bad ideas, which is the business schools. And they broadly think that an industry's structure should dictate the conduct of the firms in the industry, which should dictate their performance. And even more broadly, a concentrated industry should have firms that have higher profit margins, right? I mean, if a monopoly can use its market power to make crazy profits, then, something that has an 80% market share, 70% market share. And that was the idea of quality or moats that really has become popular. I think it was popularized by Buffett and Michael Porter. And I think the only problem with it is that it's completely empirically wrong. I mean, there's just no evidence for that. There's no evidence that market share and profitability are related. There's no evidence that that creates barriers to entry. It's just all a bunch of useless speculative theory.
You have contended that profit margins are mean reverting. Mm-hmm. Are they?
At least empirically they are. Now, they don't perfectly mean revert. So if you have a 20% margin business and a 2% margin business.
Well, Jeremy Grantham at GMO, which is an illustrious money management firm in Boston, it contends that something has happened. And observing the data, he points out that profit margins have not, for years, seemed to mean revert, that they have remained elevated. And he questions whether something isn't different under the sun.
I think, and I think that Grantham is talking about something that's slightly different than what I'm talking about. I'm saying within the cross-section of, if there are 3,000 or 4,000 U.S. public equities, and you take all of their margins this year, next year, will there be mean reversion observed? And the answer is yes. Now, on a market-wide basis, I don't. I think Grantham probably has more insight than I do as to that.
Yeah. So many everyday observations that seem so commonsensical seem to find their polar opposite contentions in the world of business academia. For example, the notion that that uncertainty exists seems to be kind of an important academic discovery. Whereas anybody who's late for a subway train and an appointment knows intuitively and in a very personal way about the factor of uncertainty. So tell us about how uncertainty plays into A, academic research, and B, into your everyday investing life.
Yeah, well, I think academics love theory. And when practice doesn't align with theory, when the reality doesn't conform to the theory, it's just proof that reality is problematic and needs to be forced into alignment with theory. I mean, I think that I'm broadly anti-theory. I think very few good ideas work. I think most theories are wrong. I think the world is far more complex and far more uncertain to be diagnosed with simple theories. And I think as an answer to uncertainty, the academic's first answer is let's have a plan. And unfortunately, that's almost the worst reaction to uncertainty.
Now, is academic, not economics, but business theory, is it inherently collectivist?
I think it is.
Is there a politics to it? And if so, what might that politics be?
I think it's a celebration of planning. I mean, I think that broadly business academia is focused on how to come up with a plan for your investment. Here's your 5-year forecast plan for your company. I mean, the only other place you see 5-year plans is in Soviet Russia and Maoist China. I mean, and you sort of see that the academics have a great affection for those types of economies because they want there to be plans.
You know, there was in the day a conglomerate called Teledyne. Mm-hmm. And at the head of this conglomerate sat Henry Singleton, a considerable prodigy who, I don't know, let's see, he went to the Naval Academy, he went to MIT, he was a formidable thinker on quantitative topics as well as other topics. He ran Teledyne with the heretical idea that you ought to issue stock when the price was high and buy it in when it was low. And he was skewered for this, for example, in the cover of Business Week for his financial engineering. I'm not sure if that term existed, but certainly the contempt for what became financial engineering existed in the early 80s. So Henry Singleton was taxed at one shareholders meeting by a guy who said, Mr. Chairman, or Mr. Singleton, I said, what is the plan? We read your annual reports. There's never any indication of what this company is going to do in 5 years. And Singleton answered, he said, here's my plan. I come into the office every day and I see what's out there. And if it's exciting, we do it. If it's not, we wait till tomorrow. That's the plan. It was pure, spontaneous opportunism, informed by price and value. Is that perhaps the long-term plan of Verdad advisors?
It is. I think that we want to be basing our decisions based on principles like buy low and sell high, principles like do what is empirically proven to work. And I think if you make decisions based on principles, whether that's Aesop's fables or the 10 Commandments, you tend to make better decisions than a sort of utilitarian calculus that, if I do this, that will happen. These causal chains, because the causal chains are, they never play out the way you would have anticipated. So
yes.
At the end of the day, wouldn't you have rather made the decision based on what you believe to be right?
So you are in the very early phase of your career, and you are in that phase of entrepreneurship that some of us remember so well, which is the knocking on door phase, right?
Yes.
Right. So, by the way, that too shall pass pretty soon. It's just going to be rich and famous.
I hope so, Jim.
But tell me, if you would, about how your pitch is met in the world of investment. So you go out and say, private equity, which is an established asset class, blessed by the great foundations and academic endowments, blessed too by the wealth and sheen of the general partners of the private equity firms, go out and say, actually, when you think about it, private equity today, given the valuations of the companies they buy, given the leverage employed, is going to produce zero returns in 5 or 10 years. That is almost mathematically certain, insofar as anything is certain about the future. In contrast, we at Verdad, with 80 million under management and with a general staff whose ages perhaps are not as advanced as some, fewer gray hairs certainly, we at Verdad have seized upon the observation that if you buy low and sell high with a leverage overlay, you will do well. Now, how does that pitch work?
I think it depends on whether people generally like or dislike heretics.
but here's the amazing thing. The heresy you described is the orthodoxy of about 5 minutes ago.
I know, there are no new good ideas under the sun. But, I think that, on some level, is there an element to us walking in and saying, here are the things we believe, and you're entirely wrong? Yes, I think there's a hubris to that. But at the end of the day, we're saying you're wrong because you think the world is predictable and knowable, and we are embracing ignorance.
Right. You sold me. But how about the Ford Foundation? So what do people say when you come to make your pitch? You obviously go and see people. You're raising money, I presume. Yeah. So what kind of reception do you get?
It depends. I think most of our investors, the majority of our investors, are professional investors themselves. And so we've had very little success with the people that allocate money to professional investors.
Asset allocators.
Yes.
How about the consultants?
I don't think the consultants very much appreciate our message either, because it's threatening. And I had a conversation with one large allocator which stuck out to me. And I said, maybe I'm wrong and maybe I'm right, but you could test whether I'm wrong or right. And I said, here's how you could test it. You believe that your managers have extremely high conviction and that their knowledge and expertise leads to that conviction, and that conviction leads to better outcomes that are more accurate. And so I said, well, why don't today ask every one of your portfolio managers to provide the 1-year profit forecasts from, what do they think, what was profit in 2017, what's profit going to be in 2018, and for each of the companies they own, and then see how accurate they are. And I will give you my prediction for every one of those companies today on the spot, which is 3%. And I'm going to bet you that if you did this analysis, my 3% forecast would be 20% more accurate than the forecasts of all of your fancy managers. And a year from now, if I'm right, we can come back together and we can talk about investing. And if not, then you'll at least have rejected my hypothesis with data. But the fact that you're betting on these people because you believe they have industry expertise, and that industry expertise translates into better forecasts, and those better forecasts translate to results, but have never asked or evaluated the quality of their forecasts. I mean, to me, it seems crazy. But the world has been, the planning, and I think, some of this is academia, right? You graduate from business school, and then you go and become an allocator, and the way you approach investing is there are 4 buckets and 5 things on a grid, and you know.
Can we not get rid of the word bucket?
Well, I've just been looking for more, other, blue collar working man's terms to integrate.
Lunch pail.
Lunch pail and hammer and lever. I mean, it's a funny thing about finance, the love of these terms. But I think, more broadly, I think the proof of what I'm saying, I hope, will be in the pudding. I think, by your fruits you shall know them. I mean, at some point, and look, private equity, I say private equity, I don't think that these vintage years are going to do well. I've been saying this for years. Well, how have the last 3, 5, and 10 years for private equity done? Significantly worse than the public market on a 3-year and 5-year basis.
Right. One of the features of private equity that is not so often talked about as it perhaps might be is the lack of transparent marking of value. Tell me, if you would please, you must in your pitches say, our portfolio is in the paper every day or on the glowing screen. Why are you taking their word for the marks when they're self-interested and perhaps for that reason not entirely objective? So is that a convincing argument, or perhaps might it be an argument against you?
It's an argument against us very much. I mean, people would far prefer to not deal with volatile things than to deal with volatile things, even if volatile things go up more. And I think that the people love private equity. For everyone in the value chain loves private equity for that reason. There are never going to be any surprises. They're never going to go to their investment committee and say, my investment in Blackstone 12 was down 13% over the past 3 months. They're never going to have to do that. I mean, it's just a mathematical certainty nearly that it'll be exactly what it was 3 months ago, versus the public equity managers where you're constantly being surprised.
Well, has anyone ever told you they prefer what you have written, you have used this phrase in print, phony happiness. Has anyone ever told you that's what they want?
We did have one allocator, I won't be named, who said they would love to invest in what I did if I could provide it in a non-mark-to-market wrapper. But I explained that the SEC did not look fondly upon non-mark-to-market wrappers of public equities.
That person wasn't kidding, I gather.
No, they were not. But I think that everyone values these smoothing effects. Because I think that volatility can lead to bad behavior. And so I think as an investor, if you're investing in volatile assets, your duty is to be able to condition your investors' behavior somehow, to explain to them why that volatility is a good thing or a natural thing, and it's not a negative. It's just knowing the world as it is.
Since Donald Trump's election, we have had, with the exception, I guess, a few months this year, we've had a most serene stock market. It's, Grant's interest rate observer, which I guess I bear some responsibility, characterized the President of the United States as the avatar of tail risk.
Yep.
All right. From that day on, the stock market was like a lake at dawn.
Yep.
Perfectly level and unrippled. And then came January or February. But this has been a time of very, very measured measured is another phrase, very low volatility. But that's neither here nor there. Dan, I want to ask you about your avocation, which is that of essayist. Yeah. So when as I mentioned at the start of the show, you turned your Harvard thesis into a published work of history, which is a rare accomplishment indeed. And you have gone on to bring the world your thoughts on financial theory and private equity and other topics, and specifically on the thoughts of the eminent Harvard professor Michael Porter, and kind of in lengthy, like I'm guessing 8,000 or so word essays. Tell me, A, how you find the time, and B, what you're up to now.
Well, first of all, I love it. I've always loved writing. I was a journalist.
Now, do you love writing or love having written? There's a difference.
I think I love both. I find the process very rewarding of distilling my thoughts. And I think part of it is, look, I am quite young and inexperienced. And so I think that I should have the burden of explaining why my ideas are right. Perhaps the bar should be greater for me because of my youth and inexperience. So I try as best as possible to lay out the logic behind what I do in the hopes that people will see that the logic makes sense and bet on me even though I'm young and inexperienced. So I think that's part of it. But part of me, I think there are so many pervasive myths, and I get bothered by them. I just, for example, in business school, we had to sit through this class on strategy, and I was just stewing listening to this stuff, barriers to entry. And so at the end of every class, I would raise my hand. I said, "Well, Professor, is there any evidence for what you've taught today, or are we asked to be taking this on faith like we did last class?" And after I asked that about 3 or 4 times, he told me that I was banned from speaking from class. But I think that
Dan, what you might have done is have just excised that last part, or is it just like last time?
I think that would have been more. I've never been known for my diplomacy, but I think there's something in me that chafes at falsehood, or I think that I want to expose these things because I think they're wrong and they lead to bad behavior. I think relying on the dividend discount model, relying on choosing high quality businesses, these things lead to problematic behaviors that lose people money.
But except if in the it's like in a way Grant's interest rate observer cavilling with the what we see as the herd-like acceptance of the myths fomented by the Federal Reserve. If people got up on their hind legs and criticized the Fed and threw stones at the economists and their forecasts, where would we be?
Well, it's true. But I think the remarkable thing to me, right, you look at the Fed, and we did a piece on this. If you look at the Fed's predictions, and as you know well, they're completely erroneous. They have no bearing on reality. And yet people time and time again pay attention to them. And the Fed, I think, has even published reports saying that their own forecasts are wrong. But people keep relying on them because they're so desperate for some, I don't know why, they're desperate for some guidance or some.
Well, I think people want to believe that somebody knows.
Yes.
There is this the first person plural, they, is a recurrent word in American financial literature. It's oftentimes kind of a conspiratorial word. In the 20s, people would say, they're not going to let this market get away from them.
Right.
Or they won't try anything before lunch today.
Right. Well,
So they used to be the forces of the Morgan Bank or of this and that pool that were legal. And increasingly, time and regulations change, and now they are the government.
And I think that, we live in this era of a meritocracy where presumably the people at the top are there by virtue of their own intelligence and hard work. I think that's very much the way we think of things. But one problem with that, I think, is that there was a piece in Harvard Magazine the other week called, it was something like the death of experts or something. And it was, isn't it so problematic that the American people don't trust experts anymore? And I was talking to a friend of mine, I said, we should write a letter. It's like, what have the experts done right? I mean, where have the experts been? I mean, the experts have been on the wrong side of almost every major issue. And so one of the things that I'm working on now to address this issue, this is my next essay that's sort of in process, but we're looking at this concept of expertise in the context of company management. So we're saying, I think there's this idea, whether it's through CEO compensation or there are many other ways in which I think people believe that in this meritocratic ideal that if we have this great CEO at the helm, a great helmsman, if you will.
Leadership.
This leader will guide the company. And that, in fact, the success of companies in the past is attributable to great leadership. And so what we're doing is we've married the entire equity database with the CEO biography database. So we can look at not only CEO characteristics, like do companies run by CEOs with Harvard MBAs outperform the market, which you'll have to wait to the essay to learn that they don't. Or do MBAs broadly outperform the market? Well, it turns out they don't. Or is past success, if you have a CEO who is CEO of one company, leaves and becomes CEO of a second company, does their success or failure at the first predict their success or failure at the second? It doesn't. Or even more, does the first 3 years of a CEO's tenure predict the next 3 years? And we're trying to ask all of these questions, I think, because not only, I think, are the results very interesting and contrarian, but I think they're revealing of broader issues that I think are quite interesting and hopefully have broader relevance than just narrowly the world of investing.
You're kind of a subversive character, Dan, if I might say so. Okay, so you have attained the age of 31. Yeah, it happens. It's happened to you. I want to ask you, knowing now what you know, what would you have done differently in your first 31 years? And then I'm going to ask you a follow-up question as soon as I get an honest answer for that one.
Well, what's that?
Would you have quit school and joined the circus? Do you hate yourself for having gone to Harvard, which is, like these experts? Stanford Business School? Right, like that. Okay, go on.
No, I think that what is St. Augustine who said, Lord, give me chastity, but not yet. And if you replace that with virtue, I'd say, it's easy to look back at all the bad things you've done over 31 years and say, I wish I hadn't done that, or wish I hadn't done that. But I think the reality is that you learn from everything. And would I be able to critique business school if I didn't have an MBA? Probably not as effectively, or at least with a lot less credibility.
Well, the weather was probably great at Stanford, wasn't it?
And the weather was great at Stanford.
All right, so here you are at 31. So what do you think for the next, given that as we say, the future is perfectly transparent and we can see into the distant, no, we can't. But given what we have just decided about the future, namely that you can't see into it, I still want you to speculate on what the next 30 or 40 or even 50 years in your case might bring. What do you see happening?
I think that my only goal is to live according to my principles and my values. And I think that I have no sense of where that will lead, but only that if I live according to those things that I believe to be true, I will act in those situations as is fitting. But I don't have a broad, great, grand scheme or plan.
How about big money?
No, I mean, I think it's interesting. So, I have this investment strategy, but what's interesting about it is that based on all the research we've done, we just can't manage much money. It's a wonderful strategy, but it can never be a big strategy. It's a small little Corvette or a Ferrari, but it'll never be a giant profit scheme. And I think there's something beautiful and wonderful about excellence, regardless of whether it's building a nice piece of furniture or running a great fund that's inherently satisfying.
Well, Dan, I would say on a very short personal acquaintanceship, I would say that I am sitting across the way from a Ferrari.
Oh, well, thank you, Jim.
Yeah, a human Ferrari.
Thank you.
And it's been a pleasure to talk with you, and I wish you all good things. In fact, I will go further. I will wish you things in the future just as lustrous as they have been in your past. So
thank you
thanks
so
for being
much,
here
Jim. I
today
appreciate it.
with us on Real Vision. Dan Rasmussen.
Thank you.
Happy days. Well, that was Dan. Dan, I think, has aged very gracefully, don't you? I mean, he was an enfant terrible in his 20s, and now he's a wise old hand in his 30s. It's a great pleasure to talk with somebody who has accomplished so much in so little time. So thank you, Dan, and thank you, ladies and gentlemen, for joining us on Real Vision.
Which historic figure would you most like to interview?
John Adams,
Why John Adams?
because I wrote a book about him, and I think he has a right to get back at me for it.